Have you ever wondered why many successful hedge funds seem to survive difficult markets while so many individual investors struggle? The answer isn't that hedge funds always predict where the market is going. In many cases, they don't. What separates professional investment managers from the average investor is how they think about risk. Today, we're going to discuss and explore the mindset behind professional risk management and discuss several principles that investors can apply to almost any investment strategy. Hey, it's Frank Nagy. Welcome to my channel where we help investors understand various market environments, risk management, and alternative investment strategies. If you're new here, subscribe to my channel and hit that like button. When most people invest, they focus on one question: how much money can I make? Professional investors usually ask a different question first: how much can I lose? That subtle shift completely changes how investment decisions are made. Every investment has uncertainty. No one knows exactly what markets will do tomorrow, next week, next month, or next year. Instead of trying to eliminate uncertainty, professional managers attempt to control the impact of uncertainty on their portfolios. Risk comes first, returns come second. Another common misconception is that risk means volatility. Volatility matters, but many professionals define risk much more broadly. Risk can include permanent loss of capital, excessive concentration in one position, liquidity risk, and unexpected market movements. Professional managers understand that risk often appears where investors aren't looking. This is one of many strategies DataBridge Capital Management applies when managing non-directional investment portfolios, with a focus on risk management and market analysis. One of the most important concepts in hedge fund management is position sizing. Imagine two investors making the exact same investment. One allocates 5% of their portfolio, the other invests 50%. If the investment declines significantly, their experiences will be completely different. The first investor has flexibility, but the second one may face difficult decisions under emotional pressure. Professional investing is often less about choosing perfect investments, but about choosing appropriate position sizes. But professionals think differently. They ask whether those investments truly behave differently during changing market environments. True diversification considers how investments impact with one another, not simply how many positions exist. Another concept professionals frequently monitor is portfolio exposure. Instead of evaluating every position independently, they evaluate how all positions combine. That's why many investment managers monitor overall portfolio exposure rather than focusing only on individual trades. Professional investors also spend considerable amount of time stress testing their portfolios. Rather than asking what if everything goes right, they ask one question: what happens if the markets decline sharply? What happens if volatility increases? And what happens if liquidity disappears? Could that portfolio withstand those scenarios? Stress testing doesn't predict the future, it prepares investors for multiple possible futures. Many successful managers don't chase every opportunity. Instead, they follow clearly defined investment processes. Professional managers recognize that consistency produces long-term outcomes than constantly changing strategies based on emotion or recent headlines. Perhaps the biggest difference between professionals and retail investors is emotional control. Fear and greed have influenced markets for centuries. Professional traders understand that emotions cannot be eliminated completely. Instead, they create systems that reduce emotional decision making. This includes investment guidelines, position limits, risk controls, portfolio reviews, and exit plans. It is also important to understand that successful investing isn't about avoiding losses entirely. In fact, every investment strategy experiences losing periods. The objective is to keep those losses manageable and so that the capital remains available when opportunities improve. Protecting capital allows investors to continue participating in future markets. Recovering from large losses is much more difficult than avoiding them in the first place. Professional investment managers don't begin with return expectations. They begin by asking and looking at risk management. By controlling risk, diversifying thoughtfully, sizing positions appropriately, stress testing portfolios, and maintaining discipline, they seek to build portfolios that can withstand a wide range of market environments. Whether you're an individual investor or simply interested in understanding how professional managers approach investing, these principles provide valuable perspective. To learn more about DataBridge Capital Management and our investment strategies, risk management approach, and portfolio construction, click on the links below in the description box.